Please tell me, can you see my screen?
Yes.
Okay, nice. So today we have the second seminar of corporate finance. I hope that all students that wanted to join us joined us. Well, 1 second. Okay, so we can start. Today we have the second seminar, and actually we have a lot of things to do today. So I encourage you to work like quickly. And today we are finally starting to solve some problems and make some calculations. Well, but to start with, I would like to somehow check what have you learned on the lecture. And I have a very simple question for you now. Please, can someone provide me some synonyms for such thing as the rate of return? I know at least 3 synonyms. What about you?
Discount rate.
Yeah, maybe. What else?
Hurdle rate and opportunity cost of capital.
Well, actually, but in general, what is the rate of the return? How we call it in general?
The interest rate.
Yes, interest or percent rate. Yeah, so this is the measure of how some quantity or some like some measure, how some measure change over time. Okay, well, nice. So we are going to solve problems today and make some calculations, and we, as I have told you, we are going to do it in the Google spreadsheets. I have prepared a spreadsheet for your group, and firstly, maybe I would like to introduce it to you a little bit, and then we will start. So I will send you a link in the chat to this spreadsheet. And what do we have here? We have several tabs. We have a tab with tasks in which I have copied the problems, which I will actually show it in the presentation like this, but the problems are also copied here, so you can use only a spreadsheet on the seminar. And also I have copied the initial data for the problems, which you can use for calculations. The initial data is color-coded in white, and the yellow cells are actually for the calculations. We have a student list here, and you can find your name on the student list, and and you will find a link to your own personal spreadsheet. Like let me show an example. For example, Diana Alexandrovna. If you click here, you will go to your personal spreadsheet. Yeah. And actually, from your personal spreadsheet, you can smoothly go to the tasks tab, and actually you can copy the problems to your own spreadsheet and calculate and make the calculation on your personal spreadsheet. Yeah, like this. So you just copy and make some calculations here. Well, what else? Some of your spreadsheets are protected if you have sent me the email, but some of the students haven't sent me the email or have sent me some other kind of email, for example, HSC email. Please, those who did not send me the Google email, please send me it, because I would like to protect your sheets like from other students or and actually this protection is needed for you for you not to be able to copy from each other. Yeah. Okay, so you just copy the problem from the tasks tab to your personal tab and make the calculation. And when like someone is ready, I will open his or her personal spreadsheet, personal tab, and he or she will show us how to solve this problem. So explain how the exercise is solved. Okay, is it clear for now?
Excuse me, so all our solutions will be somehow evaluated or only those who will explain?
I think only those who will explain, I think, because actually
Okay.
it's the activity. Yeah. Well, so I will send you the link now in the chat. So now please take 1 minute to open the spreadsheet, find your personal tab, and when everybody is ready, we are going to proceed with solving some nice
It's our
problems.
permanent link for the corporate finance course, or you will send it every class?
No, it's you will have only one spreadsheet for all the course, and actually all the solutions will be placed on the tasks tab after the seminar. I will place all the solutions here, so like to prepare for the exam or midterm, you will be able to look at them. And actually, your group, like you are the first group to use this this kind of spreadsheet. So we will have some kind of experiment today. Okay, does everyone have access, or does anyone have some problems?
Sorry, your microphone is off.
Oh, I'm sorry. Okay, so if you have some problems, please tell me. If no one has problems, let's proceed with solving some exercises. Okay, I will show the exercises on the slides, but actually they are the same in the spreadsheet, so it's up to you whether to look on the slides. Well, actually, the first exercise is quite simple. It's like devoted to the calculating the rate of the return or the interest rate. Actually, we have stock prices of Tesla Motors for 5 months from June 2021 till October 2021. And actually, the task is to find the monthly return for each period and like forecast the return for the next month, assuming that the current growth remains. So if we look at the spreadsheet, we have several kind of stock prices here, like open price, high price, low close, and etc. Actually, I suggest to use the adjusted close price for this exercise and calculate firstly the return in absolute terms, like on how many dollars the price of the share grew, like from from June to July, from July to August, and etc. And then to calculate the growth rate in percent. Okay, so I can give you a couple of minutes to do it. Let's start with the first part, find the monthly return for each period in percent. And when someone is ready, just turn on the microphone and we will go to your tab for you to explain us how to solve it, okay? Okay. So I think a couple of minutes is enough. It's very simple.
Maybe closed value minus open value, then divided by open value and multiplied by 100.
But you said that we should use a just close for absolute return. Maybe we should use 687 and divide it by 680, and after it multiply by 100%, and we will see the numbers after the comma will be absolute return. It's just the idea.
Your microphone.
Finish. Okay, no.
Yeah, I'm sorry. Please tell me if I'm well. Tell me to switch the microphone on, please. Okay, so who can show it on the spreadsheet? Yeah.
I can show, but like we should solve all the. Is it okay if I'm not already with the expected return?
Yeah. Let's start with the first part with the
Okay.
like monthly return. So
Okay.
Arina, yes.
Yes,
Okay.
but I cannot. Oh, yeah.
Okay, so does everyone see my screen with Irina's tab?
Yeah.
Okay, nice. So okay, please explain us how to do it.
So to find the absolute return, we should just which is to subtract. The previous value from the value that we have now for this month. For example, for the EU, July,
Yeah.
we should supply, we should subtract 680 from 687.
Mm-hmm. Yeah, you
So-
can like open the cell and show the formula.
Okay, great. So it's like this.
You can well, we cannot see it. So okay, let me do it like this. Okay, so you just subtract the current price. Well, you just subtract the previous price from the current price. Okay, it's clear, I think, for everyone. And how we calculate the percentage, like the monthly growth rate?
Then we just divide this absolute return by the previous year value.
Yes. So yes, it's actually absolutely correct. So does anyone have questions about it? So as you see, the price of Tesla, like from September to October 2021, grew by 44%, like added a half of the price. Yes. Okay. If no one have questions,
So
let's proceed.
excuse me, I have a question. Could you
Yeah.
please explain why are we provided with the information with the open, high, low, and close tables? Or I probably don't understand something. Why?
Actually, for
Why
this
do we need
problem, we do
only
not need this.
ADG close?
For this problem, we do not need this. Yeah, it's like just
okay.
the copy paste from Yahoo Finance. Yeah.
Okay.
We can use close price or adjusted close price for calculations, or like, or maybe we can use open price, for example. Open price is the price for the beginning of the day of the first like June here. Close is the price for the end of the day, and adjusted price. Well, we will discuss it on the seminars about stocks. Actually, adjusted price. It is adjusted for some changes in like in stocks. So sometimes stocks are splitted in two, for example, and if we split stocks, the price of stocks will be like twice lower, for example, and here we will have 340, but in adjusted price we still will have 680 because adjusted price is used for actually capturing the dynamics of the price. Yeah, and
so can we consider this like average price for the stock?
No, it's actually the closed price. The closed price. So
the closed. Okay. So okay, I got
price
you.
for the end of the day.
Yeah. Also, I would like to ask you: could you please give me this access to edit my table? So I couldn't write anything.
Actually, it's strange. Okay. So let's look at it. You should. Well, you can see the.
Yeah, I see. Probably I should refresh my page. So it's
maybe
fine. I will.
Maybe you just entered the spreadsheet with another account. Maybe.
Yep. It's not, but I will solve this. So it's okay. Let's move on to the next.
Okay. So well, who is ready with the next part of the task? Actually,
I can show if it necessary.
Yeah, okay, let's go. Let me find you. Okay, so what is going here?
I just took percent from the last month, it's 44, and multiplied by adjusted close and minus adjusted close to obtain return.
Yes, actually, we expect, for example, that this growth will remain for the next period. So we just need to add 44% to the last close price. Yes, and we have 486. Okay, does anybody have questions? Okay, let's move on then.
Can you show the second one?
Yes, well, but wait for a second. Let's return for a moment to the presentation. Can someone explain what is discounting or calculating the present value, and for what purpose do we need this? And what is compounding or calculating future values? So because the next problems will be on present values and future values. So I need someone to explain for all of the group, for the whole group, what is like discounting and what is compounding actually.
So compounding interest, it's as I remember, interest on the interest. So the result of the reinvesting.
Mm-hmm.
And
Yes.
Discount and I don't actually remember. It's like for the to find the present, for the present value of something.
Yeah, and what is the present value?
Present value. It's
With
present value.
discounting, well, finding present value, we find the value of some future cash flow that it's worth today.
Mm-hmm. Yes. Well, in other words, so when we are talking about the discounting, we are answering a question. So how much should I invest today? So what is the present value of my future investment, of my future cash flows, to receive some cash flow tomorrow? Yeah, and the compounding is the controversial thing. So how much I'm going to receive tomorrow if I invest, for example, 100 rubles today? Yeah, I will send you this slide, and actually you can use these questions if you are not sure whether you should use like discounting or compounding, calculate present value, future value. So use it, please. Okay, so for on the last seminar, we haven't managed to solve this task, and I asked you to solve it at home. Well, someone wanted to show the solution. Who can show the solution?
I can show the first part.
Yeah, who are you? Daria, yes?
Mm-hmm.
Okay, 1 second. Yeah. Okay, show us, please.
Like we should subtract investment and consumption from the income, then multiply by the interest rate, and add to it the return from the investment.
Mm-hmm. Okay, yeah, so can you please explain in more details the first part? So why we should extract the consumption and the investment and multiply it by the interest?
To understand how much we have, like after the investment and all the consumptions we did.
Yeah. So and this part, which we which remains in the end of the year 0, yeah, we are going to invest in some, for example, deposit or something with the interest rate of 10%.
Mm-hmm.
Yeah. Okay. And actually, I will encourage you to. Well, I understand that this was maybe solved at home, but I encourage you to use like the links to the cells. It will be more like understandable for all of us. Okay, and who can explain the second part of the task? Well, have someone solved it at home?
Second task?
Well, the second part of the task, which like this part, which were given at home. What if the investment opportunity gives only $53? Will this guy invest in the project, or and how much money will he have next year?
Well, I can show it.
Yeah. Okay. What's your name?
Ilyashenko.
Mhm. Okay.
Well, if I understand correctly, I should just minus investment from return and -1 to obtain the % interest rate.
Yes.
And then I just took formula from this part and calculate the whole return from the investment.
Well, so let's discuss this. So we have another investment opportunity. The last give us like $80 of return, and the new give us only $53. And if we calculate the interest rate on this investment opportunity, it will be only 6%. Yes. So the first question: will Mr. Bird invest in the project?
No, because the final return would be much lower than that his income and with his investment.
Well, actually, he won't invest in this project because he can use this money more. Like he can earn more on this money if he invests in some other opportunity on the market, which will give the interest of 10%. Yes.
So we just compare this rate and interest rate, yes?
Yes.
And if it's lower, we shouldn't invest.
Yes. So here you have calculated his income if he invest in this opportunity. Well, let's try to calculate the income if he like does not invest. Yeah. What will he have in the end of the year? So he had an income of 100. Then he consumed $30, and actually he won't invest in this investment opportunity. So every dollar that remains after his consumption, he can invest on the market with the interest rate of 10%. Yes, and actually he will have $77 in the end of the like in a year. So and here you can see that if he invests in the investment opportunity, which gives only 6%, he will have only $75. But if he invests all the money that remains after consumption on some like on the market with the interest of 10%, he will have more, like $77. Okay, does anyone have questions? No? Okay, so the next task is quite similar. We had Mr. Bird, and now we have Mrs. Anderson, who have.
Excuse me, can you please accept requests from Anfisa Popova and Daria Chernevskaya for the lecture?
Request to Teams?
I suppose yes.
Mm-hmm. 1 second. Yeah, I have accepted it. Okay, for the guys who joined us recently, we are working in the Google Spreadsheets, and we have the link to this Google Spreadsheets in our chat. Okay, so the next task is about Mrs. Anderson, who have $60,000 of income in the year like in this year, and we'll have $40,000 of income in the next year. And the market interest rate is still 10%, like in the case of Mr. Bird. And well, but the interesting point is then that Mrs. Anderson is going to consume $80,000 this year, so now. And the question is, how much money will she have the next year? Well, first of all, before you start your calculation, well, tell me what does it mean that she will consume more than the income that she has? What does it mean? Where should she find the money?
From
She will
savings?
borrow,
Oh,
or
from
maybe
Oh, well,
she will borrow or just use her savings.
well, but let's assume that she doesn't have any savings.
She will take a loan.
Yeah, so, and actually she will take a loan, let's say from the market with the interest rate of 10%. Yeah. Okay, so please calculate how much money will she have next year. I think a couple of minutes is enough, and when someone is ready, just show us how to solve it, okay?
okay.
I'm not sure that I did it all right, but I can try. Oh, you don't switch on your microphone.
Sorry, that's my problem. I apologize for it. What answer do you have?
Okay, attracting debt is minus 22,000. So the future value should be equal this value, but with minus sign. So 22,000 in money next year is for income for the next year 4,000 minus 22,000, 18,000.
Well, let me show you your tab. Yes, actually, this is correct. So, well, let's do it step by step.
Okay.
Firstly, what what amount of debt? Well, what amount of debt the Mrs. Anderson needs? What?
Okay, we have income for this year, it is 60,000, but the consumption is higher than the income. That's why we have subtract from 60,000, 8,000, 80,000, and after it, we should multiply by the interest rate because we have not only this money, but we should take a loan. So, so we should multiply it by 1 plus 0.1. And after
okay, and what other students think? Should we add the percent here? Should we should we attract debt with the percent or not?
I think no, because this is the debt that we have today.
But
And
future value.
the future value will be 22.
Yeah.
Okay.
So and in the future value we should add the percent.
Okay, I understand it.
Okay. Well, and actually in the next year we are going to repay the debt with the percent. So this is 22, and the Mrs. Anderson will have only $18,000. Okay. Is it clear for everybody? Maybe any questions?
No, thank you.
Okay, let's move on then. Well, the next exercise is about like interest rates, and if you look at the slide, I have found a real deposit of one Russian bank, which gives 8.5% rate. And actually, if you invest 100,000 rubles at this interest rate, how much will you have at the end of the 8 years? And we have here two options. So we can withdraw interest income from the account like every year. So we like when we receive the interest income, we withdraw it and like put like in our like on our table. And the second option is we assume that the interest income is capitalized, so we do not withdraw interest from the account, but it like remains on the account, and here we use like compounding interest. Okay, so couple of minutes to solve, and when someone is ready, let's discuss. So I have here two templates for solution. Let's solve it in a simple way, and then maybe I will show in more details how it works like this. Okay. Okay.
Excuse me, can I show the first part of the task?
Yes, of course. Well, who's speaking? I cannot see you.
Alakaev Artur.
Okay. Well, okay. Let's look at it. So what is going on here?
So we have the starting value of investment, which is 100. When we multiply our initial investments by the interest rate, and as we withdraw the account every year, we just multiply the resulting amount by the number of years, which is 8, and get the final result.
Yeah. Yes, you're absolutely right. So here we do not withdraw interest income from the account. And well, I can show it in more details. Well, let me copy it from my own spreadsheet. Okay, so you see that like we have this number is account value. The account value for every year is the same. So we put 100,000 rubles in year 0, and we have this actually this number at the end of every year. In the end of every period, we have some interest. So like it's actually 8.5. So for the year, we earn 8.5 in interest payments, and we withdraw this interest and put it somewhere, like not in the bank, somewhere we like store it at home. let's say so. And actually, every year we do this kind of operation, and in the end of the 8 years, we are going to have 168,000 rubles. Okay, who can show the second part about when interest income is capitalized? So when we store the interest income on the bank account.
May I show?
Yes, who are you?
Sazonova Alena.
Mm-hmm. Okay.
So,
explain, please.
So we take our investment and multiply it by our interest rate, but we don't take money from the bank, so it is capitalized every year
Mm-hmm.
by this percent, and 8 is the number of years.
Yes, you are absolutely right. So let me show it in details. One second. So you see that the account value, our account value, is every year it is growing with the interest rates. Yes, so we earn some interest for the first year and put it on the account value, and the interest of the next year is calculated using this new account value, and that is what's called capitalizing or compounding. And that's why our interest payments are also growing with time. So in the first case, our interest payments were the same for the every year. In the second case, our interest grows with time, and we have much more money in the end. Okay, so any questions for this part?
Why in the previous task we don't have multiplying the coefficient for interest? We have a similar one.
Well, in the previous task, you mean here?
No, I mean the previous part of the third task. Yes, here.
Well, because we withdraw interest income from the account, so we have earned some interest income, 8.5, yes, and we just take it from bank and store it, let's say, at home, yes, in our pocket.
So and we have $100 at the end of the first year.
Yes,
Okay.
in the bank account.
And what is the formula for this task in the simple way?
Well, in the simple way, just одну секунду. In the simple way, we just like, well, so we have an initial investment, yes, and we add to this initial investment the same multiplied on the percent rate and multiplied on the number of years. So if I'm not mistaken, here it's quite like more like from the lecture. So we take the initial investment, multiply it on 1 plus percent rate, and multiply on the number of years. Okay. Well, let's move on then. Actually, who can explain me what is the discount rate? Like in your own words. Let's now return to the presentation for a while.
Well, we use discount factors to compute the present value.
Yes. Yes, but what is actually how we estimate the discount rate?
we need to divide one by.
Yeah, it's the formula, but like in like common sense terms. So how we can estimate the value of the discount rate? So should it be 10% or 15% or I don't know 30%? Like what is the core? Like what is the meaning of discount rate? What like how we should estimate it? For example, if we have some investment opportunity, so our friend suggests us to invest in his project. So how should we estimate the discount rate for this project?
If I'm not mistaken, we compare it with other similar projects that have the same risk and took that discount.
Yes. That is why this rate is also called the opportunity cost of capital. So how much will we receive if we invest in a project with a similar risk? So our friend, for example, suggests us to invest in his project. We should find a similar project, look at how much we can earn there, and like with a similar risk, and only only after that we can decide whether it is like profitable to invest in our friend's project or not. So actually, in other words, is the minimum required interest rate. Yes. Well, for example, let's consider a question. So assume that you are an investment director of some corporation and you want to attract the investment for a particular project from the shareholders. So you are that friend that we discussed on the previous slide who suggests somebody to invest in his project. And actually the project has a market average risk, and you are, let's say, you expect that it will gain 15% of annual return on investment. So you return, someone invest 100 and have 115 in the end of the year. Okay, and in the same time, the shareholders that are going to invest in your project, they have several investment opportunities apart from it. For example, they can buy Russian government bonds with 7% of annual return, some stocks on the market with 11% of annual return, or buy lottery tickets with 50% of annual return if the tickets are lucky. Yes. So in this case, what do you think? What is the opportunity cost of capital for the shareholders? So what is the discount rate?
Maybe 15%.
Well, actually, 15% is the expected return, but when the shareholders,
the 11%, like.
Yes, why?
Because it's the first one is governmental bonds. It's not really comparable with the company. The third one is something like lottery tickets, not the same at all. And the second one is stock market. So it's like pretty what we want from the shareholders. So
yeah, and actually I have put here these words. The project has a market average risk. So actually the project is as risky as investment in some stocks on the market. Yes. And well, in this case, it is a good decision to invest in the project because with the same risk, or like in the market, the project will gain more profits, than if you invest just in like bonds or just in the stocks on the market. Well, and in the case of lottery tickets, they are like very risky because you have this kind of return, but but the risk is very high, so you have this kind of return only if the tickets are lucky. So it is not your discount rate. And in the case of Russian government bonds, you have 7% of return, but you have a really low risk. Yeah. So in this case, the discount rate is 11%. So we should compare our expected return of the project with this annual return, not with this and not with this, only with the return of the investments with the similar risk. Okay. So, well, let's calculate present values. If the annual interest rate is 12%, what is the 2-year discount factor?
Can I show?
Well, who is speaking?
I was.
Well, I cannot see. Okay. Okay, let's find your list.
So yes, here it is. This is the formula. We use 1 divided by 1 plus our interest rate, and in the degree of the years that we need. In our case, it's 2. So this is the formula.
Yes. So it's just the formula from the lecture. So, well, any questions? If not, let's move on and find the present value of $100,000 expected at the end of the 1 year at a discount rate of 25% per year. So let's assume that you have an investment project and you invest $100,000, and like you have some expected return in the end of the year, but actually, what is your value of this? Well, no. I have mistake. No, забыли. Well, you have an investment project, and you assume that in the end of the year you will get $100,000. And if your discount rate is 25% per year, what is the present value of this investment? Yeah, let's calculate it.
Can I answer this, please?
Yes, let's go at your tab. Okay.
Yep, and as for the future value, we have the formula, the previous value multiplied by the percentage plus 1 and multiplied by the number of years. To calculate the present value, we just divide the future value by the 1 plus percentage and multiplied by the number of years. And we received the 80,000.
Well, does everybody agree with what's your name? With Tatiana? Does everybody agree?
I think yes.
Well, actually, if we look at the discount factor, yes, we can see that we are going to not to multiply, but put like, well, how it's called? Well, возвести в степень, yeah. So in this case, when we are calculating the present values, we just like multiply our expected value of investment at the end of 1 year by the discount factor for the 1 year. Yes. And
I changed the formula a little bit. Can you like
yeah.
It hasn't. Oh my god. I'll try it again. Sorry. Now it has been changed. Is it right?
Well, not actually not, because okay, let me show the like maybe some other student can show us.
But the result is correct, right?
Yeah, the result is correct, but
I guess you can see my formula.
Alena, yes?
Yes.
Yeah, so yes, so we have a discount factor here. It's 1 divided by 1 plus the discount rate, возведенная в степень of 1 year, yes? And we should multiply the expected investment value at the end of the year on this discount factor. Actually, this, like, what does this value show us? So, like, can you explain in your words what is present value of this $100,000 of expected return at the end of the year?
So 80,000 dollars today is the same as $100,000 in the future.
Yeah, but how can we use this information?
We can use this information to value how much we should invest to get some particular number in the future.
Yes, actually, absolutely. So if you invest $100,000 today, you are going to have $100,000 tomorrow. Yes.
So this investment is like future value.
Yeah. So this $100,000 is the future value of this $80,000. Yeah. Like this. Okay.
Can you just show the formula for 1 second one more time? Yes, thank you.
Yes, of course. So, well, maybe let's move like deeper in the details. So, if we invest this amount today, and we have like interest rate of 25% per year, so we are going to have 100,000 in the end of the year. Yes. So this is the future value of this, and this is the present value of this. Okay, any questions?
No.
No.
Okay, super. Well, I think that we can skip the following task and actually, well, let's return to the presentation for a while. And can you please explain what is the net present value? And actually, what is the sense? Why we calculate net present values? What information can it give us?
That is probably net present value is about how much we gain after we invested. So that is our current plus money we gains.
Yeah, our plus money that we are going to gain. And what do you mean by plus money?
Just like сейчас английский вспомню быстро.
The profit that we will gain investing in this particular project after some amount, well, after some years, I guess.
Yes, but is it the whole profit or some part of the profit?
No, it is the whole profit minus our investment, I think. So it is just a part that we will have over our investments.
Yes, actually, it's the definition of the profit. Yes, so some part of money that we have when we, for example,
It is
subtract the investment from our revenue. Yes?
Yeah, it just profit from our investment, like this.
Yeah, but is it the whole profit or some part of the profit from our investment?
Maybe if it's called net present value, maybe it's just a part, which is like the real value. I'm not sure.
Yeah, okay, so let's discuss an example. So for example, you have investment project that will let's return to this example. Yes. For example, you have an investment project that is going to give you 15% of annual return. Yeah. And well, 1 second, I'm sorry. Well, okay, let's proceed. You have an investment project that is going to give you 15% of annual return, and your discount rate is 11% of annual return. So it's the opportunity cost of capital, the opportunity interest rate, the interest rate of alternative investment. Yes, and when you are going to calculate the net present value, you are going to estimate what is the estimate the part of the profit which distinguish your project and the project if you invest in stock market by 11%. So it's the additional profit that is going to be received, the additional profit of investing in this very project and not investing in the average market, for example. Yes.
4% in this case, yes.
Well, in percent, for let's say for 1 year, yes, it will be 4% of your profit. Well, for several years, we cannot say how much it will be. So, but we estimate it in dollars. Yes. So actually, when we discount, we find a present value of our future cash flows. Yes. And our future cash flows, they depend on the return rate of our project. And for example, if we compare two projects, one gives 15% of return and the other gives 11% of return, the NPV for the first project will show how much you earn if you invest in the second project, in comparison if you invest in the first project. Okay, let's look at the example. Okay, imagine you are starting a digital business. We have discussed it on the previous seminar. You are going to buy a laptop for 100,000 rubles and a website for 150,000 rubles. The business will provide you a cash flow of 100,000 rubles annually for 5 years. And actually, your friend has a similar business. He does the same thing, the same digital business. And he invites you to invest 150,000 in his company instead of starting your own company. Yeah. And his project will provide 15% of annual return for 5 years. Well, so in this case, what is the discount rate for your own project?
%.
Yeah, actually, yes. So, well, here you have two investment options. Well, I have a mistake here, so please read that we have a website for 50,000 rubles. I will do it on my tasks tab. 1 second. Website for 50,000 rubles. Okay, so investment in both cases, if you start your own company or invest in your friend's company, the investment is equal 150,000 rubles. Yes. Okay. So you have two investment opportunities: to start your own business or to invest in your friend's business. And can you please calculate the cash flows of your own, like if you start your own business, the discounted cash flows of your own business, and calculate the NPV? Well, I think we should give some time to other students. Yeah, like let's give like a couple of minutes for everybody to calculate, and then someone will show us. Actually, Arina, you already have a plus for this seminar, so I would like to.
It's not Arina, like.
And who are you? Who are you? Show up, please. Okay. You can show, but let's give some time to other students. Okay, like 2 minutes. Okay, I think we can discuss. So, Aruzhan, yes, you want to explain? Okay, let's look at your tab. Okay. So, okay, just explain us what is going on here.
Yeah, we have a formula for discounted cash flow, which is like
with cash flow. So you have 115 year, in like.
Yeah, actually, I have to have 0. Like, I guess it's just an investment.
Yes. Okay. Well, maybe we should do it with minus, yeah, because it's outflow.
Yep, 1 second, like this, and then I will remove the minus there. Yep.
Okay, so let's proceed.
Yeah,
and we
okay.
100 other years. Yes, I think it's clear for everybody. Well, what should we do next?
We should calculate discounted cash flow using the formula.
Yeah, so we actually like multiply the cash flow on the discount factor. Yes. So
divide cash flow into discount factor, like 1 plus interest rates in the power of number of the year.
And what in this like line discounted cash flows, for example, if we look at the discounted cash flow for the third, like for the end of the third year, what this value shows us?
Well, this is the value of like expected future cash flows to evaluate expected future cash flow.
Yeah, but why why do we call it discounted cash flow? So what does it show?
Yeah, the percentage. Like we are using interest rate.
Yeah, actually, it shows how much this 100, like 100,000 gained at the end of the third year. How much does it cost today? So it's the present value of this cash flow for the end of the third year. Yes.
Yep. Sure.
Okay. And okay, what are we going to do the next?
Well, to estimate whether this investment is successful or not, we should calculate NPV. Well, for that we sum all these discounted cash flows, I believe.
Yes.
And we should extract investments that we, invested in the very beginning.
Yeah, so it's actually like the measure of the profit of our
company.
Yeah, of our profit. So should we invest in like starting our own company, or we can invest to our friend's company based on the NPV? What do you think?
Well, I guess we should invest in our friend's company.
Why? Well, actually, as we have discussed earlier, NPV, like net present value, is the value that shows us how much we will gain like investing in one project compared to investing in some other project. Yes.
Yes.
Yeah. So like if we use 15%, it's the expected return of the project if we invest in our friend's company. Yeah. If we use this value as a discount rate for our project, and we have a positive NPV, should we start our own company, or like it is more profitable to invest in our friend's company?
I guess it's still more profitable to invest in your friend's company.
Okay.
No, yeah, maybe.
NPV is not negative, it is positive. That's why it's better to invest in your friend's company, not in your own.
Like,
yeah, actually, actually, you say the right words, but it should be vice versa. So okay, again, we are comparing what is like more profitable, to invest in our own company and have these values, or invest in our friend's company and have 15% of annual return. Yes. We calculate the discounted cash flow. So these are the cash flows, like the present value of our future cash flows if we invest in our own company. And for example, if we like, okay, let's discuss it in this way. So what do you think? What is the rate of return if we invest in our own company? Is it more than 15% or less than 15%?
I guess more.
Yeah. Yes, and it is more just because the net present value is positive. So when we discount by 15%, when we discount our future cash flows by 15%, we still have like a positive net present value. So actually, it means that we gain more than 15% a year on this investment. Yeah.
I thought, like my mistake was that I thought that we just need to compare it with another like cash flow, and instead of investment, it would be like 250 because he spent 100 for the laptop and 150 for the website. So that was my mistake. That's why I thought that it's better to invest in. Oh, okay. Yeah.
Yeah, like I have said that I have made a mistake. Yes, so
I forgot.
I apologize.
Remember
Okay.
you.
Well, so if the investment are equal and the friend's project gives us 15%, and we have a positive NPV when we discount by 15%, like our expected cash flows. So we have some like markup, some additional profit if we invest in our own project than if we invest in our friends.
Yeah,
yes?
now it's clear. Thank you.
Yeah, is it clear for everybody?
So it will be more. It will be better to invest in our friend's project if NPV will be 0 or less than 0.
Yes.
Right?
So actually, if NPV will be like less than 0, let's say that we have, I don't know, 0 cash flow here and 0 cash flow here. Well, and 0 cash flow here. We have negative NPV. What does it mean? It means that our project do not provide us like that our project provides us less than 15% of annual return. Yes, in like on average. And in this case, it's better to invest in our friend's project, like to an alternative investment option. Yes. So we
Well,
every time when we are.
May I ask a question?
Yeah.
We just calculated the NPV for our project.
Yes.
Right? And if it's negative, for example, then we have to, you said we have to invest in our friend's project, but we haven't calculated NPV for that one.
Yes, net present value
it may be also negative, for example, and what should we do?
Well, when we are going to assess the NPV of the of investing in our friend's project, we are going to calculate the discount rate for this project. Yes, and the discount rate will be the percent rate, the interest rate of an alternative investment, and the alternative investment in this case will be investing in our own project. Yes, so we'll make the vice versa operation. And if our project give us, for example, 13%, let it be 13%, yes, a year, we will still choose the project of our friend. Yes. So net present value is always about comparing with some alternative investment opportunity. Yes, it's not like we cannot say that we have NPV for this project like in a vacuum. Yes, we have NPV of this project like in comparison with some investment opportunity. Yes. So if we say that we have a discount rate of, for example, 20%, it means that we have some investment opportunity that will give us 20% with the same risk. And in this case, again, let's discuss it again. So we have like an idea to start our own business, and it will give us these cash flows like by the year. And we have an investment opportunity, like an alternative investment opportunity to invest in our friend's business the same amount of money and have 15% a year. And we should compare these two opportunities. And for this purpose, we calculate the NPV of our own idea of our own project of starting our own company. The discount rate will be 15%. It's the rate of the alternative investment opportunity that our friends suggests us. And actually, if the net present value is higher than 0, it means that our project gives us more than 15% a year. Yes. So in this case, we should choose our project. Yeah, if the NPV is less than 0, it means that our project gives us less than 15% a year. And if the NPV is 0, it means that our project gives us exactly 15% a year. Yeah, is it clear?
Yes, thank you.
So the thing that we didn't know and were searching for in this task was the alternative, maybe not alternative, okay, investment rates for the starting your own business, right? Through
in this
NPV.
task, we somehow compare, like we make an investment decision. So we think whether we should invest in our own company or not. Yeah, and like we have 150,000 of rubles, and we think, should we start our own company or not? And for this purpose, we like calculate NPV and compare our own idea, our own investment opportunity with some alternative investment opportunity. So we have 150 rubles, and we like we have a required level of risk. So we are ready for this level of risk of this digital business. Yes, and we want to invest this money like as effective as it can be. Yes, so we want to gain as much as we can, and we like just compare our own idea, our own investing in our own business with some alternative investment opportunity, which gives us 15% a year. So 15% is our discount rate for this project. Yeah, and if NPV is more than 0, we should invest in our own project. If NPV is less than 0, we should not invest in our project and rather invest in some alternative which gives us more, like 15%.
Okay, thank you.
Okay, so should we finish now? If I'm not mistaken, the time has run out. Yes.
Yes.
Okay, so we have another task in the presentation and actually in the spreadsheets. So it's, well, the task is similar to what you have done on the lecture about calculating the payback period and discounted payback period. So please then solve it at home, and we are going to return to this in the beginning of the next seminar, which will be in the next Friday. Okay.
Okay.
Because I think that we do not have time now to do it. Okay. So, well, thank you very much for the seminar. Well, we are just starting to use these spreadsheets, so I'm sorry if there was some like misunderstanding and if something went not smooth. Okay, but I think in the next seminars we are going to like improve our usage of these spreadsheets. Well, now if you have some questions